Hello everyone, I'm Chris Sullivan, Head of Customer and Distribution Management for the Central Region of the U.S. And I want to welcome you to our latest webinar, Unlocking the Mystery of Non-Damage Business Interruption Insurance. Last month, many of you joined us on our webinar on parametric insurance solutions. If you missed it, let us know and we'll share the recording. During that webinar, we polled the audience on topics for future webinars, and overwhelmingly you told us you wanted to hear more about non-damage business interruption. So here we are. Leading our discussion today will be Scott Carpenteri, Senior Vice President in Innovative Risk Solutions at Swiss Re Corporate Solutions, where he partners with corporate and public entity clients to develop customized insurance products. Previously, he was responsible for the treaty reinsurance at Swiss Re as a reinsurance structurer, treaty underwriter, and pricing actuary. He holds the Associate of Casualty Actuarial Society designation and has over 20 years of industry experience. Scott is passionate about the customer and spent the past 9 years creatively solving client needs by combining technical knowledge and innovative insurance solutions. Originally from Connecticut, he's called California home since 2001. He's been known to use both wicked and dude in the same sentence. So now before I turn it over to Scott, just a few logistical details. To make sure everybody can hear the speaker, we've muted all participants. And we want to make this an interactive session. So please ask us any and all questions you have using the box at the bottom left-hand side of the screen. I'll read them during the Q&A session at the end of Scott's talk. If you experience any technical difficulties during the webinar, please force a refresh by pressing Control F5 without leaving the platform. So now, Scott, over to you.
Thanks, Chris. Appreciate that. Really pleased to have everyone joining today. This was a popular webinar here, so we've actually had record number of registrants. So for those listening today, if you're wondering, am I the only one on here? You are not. So really pleased to have you join. Thank you for taking the time. We realize that everybody's very busy. There's a lot of webinars going on these days, and we really appreciate you joining us. And we hope that you gather some great information from this. You'll find that we're doing it audio only, and with the slides here, there are some Zoom-style webinars these days, but I will say that I haven't shaved since the second week of March, so you really don't want to see me online. So we'll get into it. We'll continue with the audio here. So just a few little introduction remarks. So. Thank you, Chris, for that introduction. Again, for folks on the call, we really appreciate you joining. Non-damage business interruption is probably one of the most complex areas of insurance as far as trying to find innovative new solutions. We spend a tremendous amount of time here at Swiss Re Corporate Solutions figuring out this puzzle and trying to find good solutions for our clients. We really hope that, again, this presentation sort of unlocks the mystery of it and gives you an idea of sort of how this works, how it doesn't work as well, what can be done, maybe a little bit of what can't be done, and gives you a breadth of how we approach the problem. For the folks that are online that are potential clients or existing clients or brokers, hopefully you get a little insight into how we approach the problem, and together we can figure these out. While this was in the invitation, just in case anyone missed it, I'm just going to sort of cut right to the chase. In this presentation will not be a solution for pandemic risk. I hope that people don't start logging out right now, but we'll hope to sort of see that through the pandemic, that our view is that folks are sort of seeing more of the risks that they're facing with respect to business interruption, and actually will sort of create a more broad dialogue about sort of what has been covered, what's not covered, what's coverable, and perhaps not coverable. And so we realize sort of that's the most common question these days and thought on people's minds. But really just want to sort of just cut right to the quick on that. And again, I hope you stay, but I wanted to just let everyone right at the top that we're not sure that's actually an insurable risk. There is actually no element of risk smoothing when you're talking about pandemic coverage. If everybody on the planet is having a claim at the same day, or at least the same year, it doesn't quite fit into an insurance mechanism. That being said, there will be some parallels here that I think that will really create some great dialogue with folks, whether that's sort of the risk managers on the call with your stakeholders, or the brokers on the call with maybe the risk managers that you work with. So with that, we're gonna just jump right into it here. So why is business interruption such a difficult risk to cover? So we're just going to go through a little bit of a touch of a background here. We think about this a lot. We are a major insurance and reinsurance company. We've seen a lot of claims. We've seen a lot of situations. We've seen a lot of just our goal in life is to try to minimize our hardship and disruption and financial pain for organizations and individuals and communities. And so with this particular type of risk, why is it so difficult? So first of all, we have to look at it from an underwriting perspective. So why is business interruption so difficult to underwrite? Well, classically, business interruption has been handled in the property insurance form. Usually it's kind of a bit of an add-on coverage or an additional coverage in your classic property insurance form. When you're talking about property insurance, you're talking usually, for at least the physical damage, the first party, very, very concrete, tangible assets. We have dozens, if not hundreds of years of experience of underwriting tangible assets. And if I do say so, I think that the industry does a decent job with that because you can actually underwrite that. When it comes to sort of business interruption, classically, if it was a manufacturing sort of very classic industries, well, physical damage led to sort of the business interruption, and they were kind of tied and commingled. And so there's a little bit easier just to get your hands around that, again, from an underwriting perspective. Again, though, that these would require a damage trigger. That's sort of where the coverage tends to live today. We won't make any commentary about sort of what's going on right now about, people questioning the trigger of the current situation. From our standpoint in the insurance industry, there is absolutely physical damage trigger, and our position is that a disease is not a physical damage. So just to put that out there. So this is classically how business interruption insurance is underwritten. When you have sort of more soft things to sort of try to quantify from an underwriting standpoint, it becomes very difficult. And this is why business interruption, it can be difficult to underwrite. Folks may not be able to get the limits that they're always looking to get, and it's more challenging from the underwriter standpoint. The second sort of leg of the stool is from sort of where we look backward. Why are business interruption claims so hard to settle? Again, in the classic insurance form. Well, again, we're not replacing a physical asset. It's sort of what would have happened but for this event. What would the revenues have been but for this event? We're getting to areas that are much more complicated to quantify, a lot of times much more time consuming to quantify. And that's even if you have a very, very clear objective trigger saying, okay, there has to be physical damage, and then you get the business interruption. Even with a non-controversial trigger, yes, there was a fire, there was an earthquake, still getting to that sort of what would this revenues been, or what were the expenses have been, et cetera, but for this event. Not exactly sort of a black and white sort of claims process. Our claims folks do a very, very, very good job working very, very hard to sort of meet those expectations and come to reasonable conclusions. But there is a little bit of a crystal ball nature of it. So that kind of leads to sometimes some misunderstandings in the classic side of business interruption. And then, of course, there's still that damage trigger that we say. So when you get to when you think about the modern challenges of business interruption and the fact that it sort of lives within the property form, well, we're not all factories and machine shops these days. There are many organizations, there are giant companies that have little or no assets, but giant business models. So how do we insure those folks with business interruption? Well, it becomes very, very challenging because classically we just used physical damage trigger to get access to business interruption insurance. What if you don't have any assets? What if your organization, like many, if not most organizations today, rely heavily upon public assets? right? You can't insure a bridge you don't own or an airport you don't own, but you use it tremendously, and it's vital to your business, to your operations. The infrastructure in and around your businesses, in your places of business, right? Vital to your continuing operations. Again, you don't own it. Not really exactly insurable from a first-party perspective. And now, in this COVID and post-COVID environment where I am standing in my home office right now, I may or may not be wearing long pants. And what do we do about this new sort of contingent business interruption, in that now the employees are doing business out of their homes on behalf of the organization? What if something goes wrong there? So really, really challenging this new modern world in trying to figure out ways that we, as the risk, the risk transfer acceptance industry, the insurance industry, can take some of these risks and really help organizations stabilize and smooth out their results. So this is why we're having this discussion today and why we're talking about this topic here today. So with that, we're going to move on to sort of the meat of the presentation here. So how does Swiss Re approach business interruption coverage with respect to non-damage business interruption insurance? So the reason why you all joined. So first of all, I'll say with a little expectation setting slide here, solutions are often tailored to specific risks, but not usually all risk covers. So again, this you'll find that this presentation is meant to be sort of very, very open and frank about sort of what can and maybe cannot be done. We do execute these solutions, but the idea is these often take a little different path than what maybe folks are accustomed to. There is a bit of a mindset of, there are all risk insurance policies that just, no matter anything that happens, I got the thing called insurance and it'll take care of it. First of all, even in the all-risk policy, there are limitations to the all-risk policy. I think it's sort of in all of our best interest to make sure that the insureds really understand those. I think we're facing an event right now where maybe there was a lack of understanding of what could and couldn't be covered. In this world where we're trying to sort of bridge that gap and sort of take some of these sort of net risks on to the insurance balance sheet rather than keeping it on the insured's balance sheet, these solutions get a little more lasered in what we can kind of bridge that gap and transfer over. So they don't always, in fact, they're often not quite an all-risk type solution. So again, want to just set the expectations there, just to make this sort of a very productive dialogue and really get everybody kind of in the mindset of sort of how we try to approach the problem. So the next slide here is a little set of squares here about the approaches. So I'll explain what this slide looks like. So basically, we think of the world of non-damage business interruption as sort of the types of paths you can go down, sort of as 4 different types of solutions. So if we start at the bottom right, so the trigger, sort of what happens to invoke coverage, you can have an indemnity-based trigger, meaning sort of here is a long list of sort of what's in, what's out, exclusions, sublimits. You can have sort of named perils, or you can have sort of all perils but for. Everyone sort of knows all the classic insurance and how they're written, right? And then in addition, so provided the triggers hit, you can have sort of an indemnity payout where you sort of, client and the claims adjuster sort of sit down and try to figure out sort of sometimes over a course of time, what's counted, what's not counted, did this happen, did this not happen, and start tallying up what the recovery should be. So that's sort of the starting with the bottom right quadrant. That's probably the toughest way. That's what I think we've been trying to do thus far. And it's very, very complex from both the trigger standpoint and the payout standpoint, right? It's this, using the more broad form approach, which again can lead to maybe misunderstandings or disagreements. And so if you flip to the opposite corner, so the upper left, this is sort of with the green box, the maybe more straightforward approach. And where we're going to focus on this particular call is more of an indexed approach to say, okay, if this particular event happened, what does that mean? We're going to have all kinds of great examples coming up later. But if this event happened, objectively, we know something very measurable that we don't have to take a tremendous amount of time to figure out if the event happened or not. And then how much is the client entitled to based on that event? And again, we can actually have an indexed approach that says, okay, event happens, the client's entitled to X amount of dollars, or client's entitled to X amount of dollars depending on the intensity of the event, right? And you'll find that this can fit very similarly. This is a close cousin for those of us who have joined our parametric webinar last month. There are ways that these things kind of look a little bit similar, and then the non-damage business interruption can go sort of into sort of the next level as far as complexity and for the insurance nerds in the audience can be really very, very cool type solutions. But that is sort of the most straightforward way of addressing this problem is sort of a index trigger, index payout. And for those that this terminology is a little bit new, hopefully as we get through examples, I think it'll clarify things a little bit. The other two quadrants, just to briefly, to address those. So the upper right, so index trigger, so that one would be sort of a very, very clear-cut trigger. The current business interruption behind the property form maybe is a little bit like this. I struggle to think if it's the upper right or lower right, but basically there's a trigger that's sort of an objective thing, and then how much it pays out, then you have to go into the sort of the forensics accountants and the quantification, right? So it's sort of a hybrid of the sort of the new world and the old world. There are times we use those, or there's some very unique cases where that one actually maybe is the best solution. And then the lower left is the indemnity trigger, so kind of a regular damageability type trigger, but then if that happens, it's a very prescribed payout. Those are very powerful solutions. We've actually executed several of those where you sort of use the sort of the regular claims process, so to speak, to determine, okay, does this qualify? But then given that it qualifies, there's just a prescribed, almost a stated value type of payout. So then you don't have to spend the tremendous time of trying to figure out sort of what would the revenues been. But for this, you can sort of set an agreed value amount that is, sort of meant to be a good proxy and perhaps maybe a supplement to what the real cost would be. Certainly not an over-indemnification situation. So with that, we'll move forward here. So again, we're focusing on that sort of what we call sort of the index trigger and index payout. Again, the cleanest of these types of solutions, and probably the best to explain on an introductory webinar like we have today. So finding the right triggers. Again, we're going to show you our approach, and together we can figure out solutions. We don't have an off-the-shelf product that we're going to say, hey, wouldn't you want to buy this? Isn't it cool? This world doesn't work this way. It is a very, very collaborative approach. So the first thing we want to identify when we're trying to figure out what makes a great trigger for a non-damage business interruption solution, what is solvable with this sort of new frontier of insurance. And so we like to look at it as a bit of a risk continuum. And so on the one side of the spectrum, you have pure fortuitous risks. A fire breaks out in your operations, a hurricane comes through, an earthquake comes through, a hailstorm damages some of your inventory. Those are very objective, they're very fortuitous. The insured had nothing to do with that, has nothing to do with the insured's business itself. It's just sort of nature and the world thrusting sort of its problems upon the business or the organization. Shift all the way to the opposite side of the spectrum, you have pure business risk, right? So these are, I invented this new tire. I'm not sure if it's going to work or not, and hey, can I insure if it works? That's kind of the whole reason why the operation exists. And so those are more sort of business risks that the investors in that organization, that's the risk that they're taking on. Whether it be I'm going to open a new restaurant in the middle of the desert, or I'm going to invent something new. We've got this new widget. It may work. It may not work. Those types of things become very, very tricky. The purest versions of those are really risks that are borne by the equity owners of the organization, or even just the stakeholders if you're talking about a public entity or a municipality. Where the sort of magic happens is in the middle, and where sort of we earn our keep, so to speak, is in the middle. Is you have risks that are somewhere in between. Maybe they're partly fortuitous, partly business risks, some sort of blending of the two or combination of the two. And so these are the places where the folks on the Innovative Risk Solutions team here at Swiss Re Corporate Solutions, where we put our heads together, again, with our clients and with our broker partners and amongst the team ourselves to see, can we take some of these unique requests and these unique sort of needs, and can we tease out the fortuitous portion of it and maybe frame it in a way that we can actually protect the fortuitous nature of the concern that's maybe keeping the organization up at night, and then still parse out and compartmentalize the risk that really is more of a pure business risk, so it's either something we just can't take on, or maybe it's not within our risk appetite to take on. So again, very conceptual here, and I appreciate sort of in the picture of the lighthouse here, this is a little bit sort of like trying to staying high level, and then we're going to again drill down into a little bit more specifics, and then we're also going to leave some time for some Q&A for everyone too. So please get your questions in, and we'll sort of prioritize as best we can and get as many questions answered as we can here. So the next slide here is the criteria. So you kind of saw the high level of, all right, so Swiss Re likes fortuitous risk, business risk probably not as much, somewhere in between, might be able to sort of do some really clever structuring to figure out sort of how do we get the transferable risks. This slide here is actually this is kind of our secret sauce here. So when we're working with folks to figure out, can we do a solution? What's an appropriate trigger? A simple example is an earthquake, right? Yes, that's a very objective trigger. It's fortuitous. Most clients are not capable of causing earthquakes. Very, very easy. On the other side of the spectrum, can you insure me in case I tap my head 3 times? No, I can't do that because you have full control over that, right? So here, these bubbles are sort of, we're illustrating the process that we go through when we're trying to figure out if a trigger sort of can make sense. So the first item is the thing in the universe correlated to financial loss to the insured? So fairly straightforward, but the stronger the correlation, the more useful that trigger is. So if it's a trigger that may cause pain to the organization, may not cause pain to the organization, those triggers can be maybe a little trickier to use. If it's a trigger that, oh my goodness, almost always would the organization have pain, financial pain, if this happens, yes. And I'll point to NatCat type ones. These don't have to be NatCat, but NatCat, so it's easy for everyone to get their head around. So for instance, an earthquake. If you've got a major operation and there's an earthquake, chances are something's going to cost you some money, whether it be actually physical damage or just dislocation of your customers, sort of financial pain to your customers, access to your site, utilities, your employee base. Something's going to cost you money. So this is sort of the idea of that's a very super clean, very clear one. So the second thing we look to see is if a trigger sort of can make sense for a solution like this. Is it objectively measurable and quantifiable? And ideally there, is it something that is numeric, right? So if it's something kind of vague, it's hard to say, okay, did the trigger happen? Did the trigger not happen? It did happen, but well, what was the level of the thing? Because we want to make sure that the policy can respond proportionally to sort of mimic the pain that the insured might be feeling. So That's sort of the second sort of objective that we have in trying to find the right solution. Third is ideally that the trigger, whatever the trigger is not only objective, quantifiably measured, but it's quantifiably measured by a third party. So in the most ideal situations, it's not the insured's own measurement, because that becomes tricky, and it's also ideally not the insurance company's measurement, because again, that can be tricky. Ideally, if there is some third party that's independent of the two other parties that is reliably measuring a thing in the universe, that everyone agrees is the sort of expert, is non-biased, and does a good job measuring these things in the universe, can that be used as a trigger? That is the ideal. And then the fourth item, which is a little bit our problem on the insured side, on the insurance company side, less of a problem on the insured side, is there some history here? Can we model this? Can we figure out sort of what the right fair price is for this, and what the right attachments are, and for the type of risk transfer solution for the budget that the client may be looking for. So item 4, again, we're very much a quantification type of company at Swiss Re. We like our models. We have PhDs roaming around everywhere wearing smocks. It's awesome. For any intellectuals, it's a fun place to work. But so, yeah, number 4 there, we figure out these cool things that can happen, it's measured, and then now can we figure out a way to either look at the past data or fit some sort of future model or some combination thereof. So again, if you find a trigger that sort of fits these 4 criteria, that is a great path to sort of finding a mutual success. So another expectation slide, and I've already alluded to this I think about 3 or 4 times, is these are very highly customized and bespoke solutions. These are probably the most customized insurance products that certainly we work with here at Swiss Re Corporate Solutions. And so just, again, to set the expectations, this is not your standard, hey, here's a schedule of values, can I get a quote tomorrow on one of these NDBI things? It's the farthest thing from. So I like to use colorful analogies, and so for the gentleman in the audience, imagine it's like going to the little tailor down the street rather than sort of grabbing a suit off the rack at your favorite department store. It's just much more customized, and for the women in the audience, you imagine going to sort of the dress designer, right? It's really customized rather than just, yeah, we've mass-produced these for everybody. Here's a great one. I'm sure it'll be fine. Now, when we do find custom solutions, though, if you carve a new path through the jungle, why not reuse it? So a lot of times you'll find that you might see something in this presentation, in some of our examples, that resonate. Well, if we've already solved the problem for one person, and it does make it a lot easier to solve it for another person. So we do like to get the message out there about things that we've done, because in a lot of cases, maybe half the work has been done already. Although even if we have a model built, we still really want to have a consultative sort of sales process with the organization to really get at their concerns. Every organization is different. They all have different concerns. Every risk manager is different. Every CFO, every CEO is different as far as the sort of the pressures that they are under from their organization and the things that literally keep them up at night. And so the next slide. So here's another sort of 4-step slide here. So it kind of brings everything kind of home here. And again, hopefully our goal in this presentation is to give you a framework of how we view this world. And so when we're sitting down and getting an initial call from a broker or a risk manager to say, hey, can we talk about one of these together? Can we brainstorm together? This is how we sort of approach the dialogue. So the first thing is to talk about sort of what are the key business concerns. What are the things that are keeping the risk manager or CFO or whomever is responsible for risk what's keeping them up at night, literally. And to those folks who are in the risk management field that really have a good grasp on, okay, these are the things that I'm faced with as an organization. These are the things that my classic insurance policy have transferred for me. And these are the things that are still net to me even after buying the risk transfer, or these are the things that are net to me because I chose to keep them net. For us, our job in the insurance industry, my feeling is, and I think our feeling here at Swiss Re is, as a risk-taking organization, we want the insureds and the clients to be just as aware as possible of the risk they're facing. You'll see that we do a lot of research on climate science and climate change, the impacts of these. We want people to have as much information as possible to make the right risk transfer decisions for them. Some organizations will transfer a lot of risk. We're here for that. Some organizations will say, I can actually take this volatility. There's only certain aspects of my risk that I need to transfer. That is completely fine too. We just want to make sure that everybody is empowered with as much information as they can as to the risk they truly face and what tools are at their disposal to transfer that risk should they want to transfer that risk. And we take a lot of pride in working with our broker partners and our clients to really make sure that we're looking at things as holistically as possible so that the insureds, the risk holders can make the best decision possible for them. So that's sort of step one, is just what's keeping these folks up at night. The next step, as we kind of saw in the previous slides, is what are some independent triggers we can use to sort of build an insurance policy that responds to that. And so again, this is a quick recap here. Ideally, they're independent triggers, which are correlated strongly with the financial concerns of the organization. Couple of quick notes on that. The product is not designed, again, for business risk, so it can't be everything that keeps the organization up at night. And then the other thing is that we still need to find triggers that are within the appetite of the insurer in the insurance company, right? So some examples would be, your classic sort of, classic exclusionary type things. War, really going to struggle to transfer a risk that has any sort of war type trigger associated with it. Nuclear, the big classic ones, and then we would say also pandemic. Many of the solutions that we put together, if it sort of rubs against pandemic, we've had a pandemic exclusion there because, again, it doesn't fit itself well to sort of the smoothing nature of having a portfolio of policies where in any given year only some of them actually trigger. Together, we'll analyze the historic data, so we'll look at that trigger that's identified and say, okay, what's it look like? Do we have some good data? Can we sort of build a model on it? One of the little inside baseball, one of the things that we'll look at here is it correlated to other things in our portfolio. If it's something that's very, very unique, that if this thing happens, we don't really have any claims that are going to show up anywhere, we can take a little bit less of a, to the 8th decimal point sort of approach as far as analyzing this. If it's something that's hyper correlated to our portfolio, we have to sharpen our pencil and make sure we're modeling it a little bit more precisely because we want to make sure that we're watching our aggregation, sort of our total risk to any particular event. Well, in addition, on this analysis stage, we want to sort of look to the client, and it's very collaborative, and say, in these situations, if this particular thing happens, what's your view of what your costs would be? I've sat down with hospitals where we've talked about these types of solutions, and what's their business continuity plan? We talked about one of these solutions once, and the assistant to the risk manager, as we were talking, her eyes kept getting wider and wider, and she looked over to the risk manager and said, "Oh my goodness, do you know that we just ran a business continuity plan, and we estimated it was going to cost us several million dollars if this thing had been real." And so anything that the insured has sort of at their disposal to think about whether they've budgeted for certain types of events, or maybe they've experienced, unfortunately, some of the events. Any kind of data, whether they just be individual data points, can be really helpful to sort of calibrate how and where these triggers should respond, and maybe how much should be sort of the payout to sort of help the organization. So again, super duper collaborative. Really, we're bringing our knowledge to the table about sort of what we can do and how we can structure insurance policies, and then the insured is bringing their knowledge to the table of having the utmost understanding about their operations, and again, what sort of risk that their operations faced, any quantification of those risks that they've done, or unfortunately, when they've lived these experiences before, they know when this happened, they've had this cost. So again, those types of data points will help us calibrate sort of where and how to set this up. And again, I've kind of drifted into the fourth box here. So yeah, so together we figure out, we've got basically, we've got triggers, so sort of figure out what the triggers are, and if we've got triggers that work and fit all the criteria, we talked about triggers. So we sort of talk about sort of where the triggers are set, payouts, sort of how much the insured is entitled to based on sort of the severity of those triggers, and then the budget. So how much does the client have to spend? So realistically, budget's important, and so trying to sort of balance that trifecta of sort of what happens, how much do you get if it happens, and then how much is this going to cost as an insurance policy. Finding that trifecta is quite the art and the science of this type of business. If we're so lucky and we know two of those, we can solve for the other. Right? So if the client knows explicitly, if this thing happens in the universe, I'm going to get I need a payout of this much, well then we can just build it and solve for the price. A lot of times though, the triggers are a little more esoteric, and so it might be that the client says, I have about this room in my risk transfer budget. I trigger that looks something like this, and I think that if that thing happened, I might need maybe $5 million of payout. Then we can sort of, knowing the budget, knowing how much money they would need, we can sort of solve for, okay, so given those, this is about the level of trigger, sort of the intensity of whatever the event we're measuring, what that would be. So again, high level, drilling down a little bit closer now to sort of, and some examples that, in the thread of this discussion here. The next slide will have a lot more examples. And then again, just this is a collaborative process. I will say, having worked on a number of these, when we find together a mutual solution, it is exceedingly rewarding. We have a very happy client. We usually have a very happy broker, and we're happy. Cynically, you might think, well, of course you're happy you sold some insurance, but actually at Swiss Re, for us, it's about closing the protection gap. When we look at events that happen around the world, and even the most insurable events, like for instance, natural catastrophe, and the level of insurance protection versus the actual economic risk, in some cases, even in very developed places, that number can only be as high as 50%. That gap of what's not insured in the world, it translates to human suffering, whether it's economic suffering, whether it's emotional suffering. It's suffering that. So we see our business as actually reducing suffering. Just as a sort of a billboard here, a few years ago during the Harvey, Irma, and Maria year, the triple hurricane year, as a group we paid over $4 billion of claims, and we did not see that as sort of a, we stuck at our poor shareholders. Now we always want to give our shareholders a return. We saw that as $4 billion worth of human suffering that we were able to reduce. Not that money fixes everything, but it can at least get folks back to a closer version of their normal life. So this is why we invest the time. This is why we invest the energy to try to figure out very, very clever ways that we can, again, close that protection gap a bit It's very important to our mission statement here. And finally, on this next slide, if I can get it up here, there we go. So yeah, on this slide here, now we're going to get, so hopefully the big picture is making some sense. If I was clear here, we're kind of getting an idea of how this works. Now we're getting to some more concrete examples for you to sort of kind of noodle on. So I've mentioned natural catastrophes a lot in this. They're I say flippantly, they're easy. In this standpoint, they fit very, very nicely into the mold. So natural catastrophes are quite straightforward. So you know, they can have significant financial impacts on businesses, and again, not just the first-party physical damage, right? There's, you know, you rely on the infrastructure, your employees are impacted, your customers are impacted, the electric grid, the water grid, the data grid. We have no idea how the data grid's going to sort of survive in some mega catastrophe. So sample triggers we can use here, very familiar to a lot of folks that know Swiss Re pretty well: hurricane intensity, earthquake intensity, storm surge, hail size. A lot of the stuff that many of you have read in the trades about us, or maybe even worked with us on specific solutions. Travel and tourism. Again, a lot of organizations rely almost 100% on tourism revenues. How do you protect those? You know, whether you're a hotel or some sort of a local tour industry, or maybe the municipality that relies very heavily on the tourism revenues. How do you protect that? So some sample triggers here that we've used is passenger flight traffic. So take a particular airport, very objective data, how many people are running through that airport in a particular month and year. All of that's public information, particularly in the US. And so you can absolutely use that as a trigger. Hotel industry revenue per available room, otherwise known as RevPAR. Another very, very powerful trigger. It's a really interesting case where you can tease out the business risk from the fortuitous risk, right? So if you're insuring a hotel, to say, well, I'm going to insure you if your revenues go down. Well, unfortunately, your revenues can go down for a myriad of reasons. Some would be fortuitous, fire, you know, natural catastrophe. Some of them are non-fortuitous. You're just not a very good manager of hotels. So those sort of using a RevPAR index, you can actually use the performance of all the hotels in the region. Now you can tease out the fortuitous, because anything that is just unique to you and your performance as a manager of a hotel will only be a small component of that industry data. But the things that are non-fortuitous, things that are fortuitous, that are outside your control, would probably have impacted your peers as well. So really interesting way to sort of bridge that gap between the fortuitous and the business risk. Specifically on those triggers, the data is really sort of impacted this year. So any trigger solution that involves travel and tourism, we'll have to figure out, one, when do we start the clock ticking, sort of when COVID ends, and then also, what do we use as the base year? 2020's data is going to be very, very unique. Weather is another place. So again, weather can really impact so many areas of business, whether it's events or operating costs of organizations or construction costs, right? You lose enough days due to rain or hot weather or cold weather, all of a sudden you're running up against sort of potential penalties and everything. And again, you might not have had physical damage on the site. The situation sort of caused an interruption to the building process. So lots of examples here: excess rain days. That's counts of rain versus of days that are rainy, versus excess rain is just a quantity of rain. So a little more flood on the first one, quantity of rain days on the second one. Too little rain, too hot, too cold. We've looked at fog days for a particular port, where if it's too foggy, the pilots won't go out, can't bring the big ships in, and it's completely lost revenue. It's an interesting way to sort of look at the world. We've even looked at observation tower whereas there's very heavy tourism revenue where folks don't go into the observation tower on a fog day. And the volatility from year to year can be very tremendous for this particular place where we're looking at that. And that was a neat way to sort of smooth out the volatility for the organization. Terrorism. Again, so in the U.S., most of this presentation has been sort of a very global view, but there's a little bit of a U.S. bias on this one. So very, very objective terrorism triggers in the U.S. that we can use, and so those are perhaps a little easier in some jurisdictions versus others. And then in others, so we are open to conversations and suggestions. So we have looked at sort of road closures in very unique parts of the world subject to landslides where we happen to have a lot of back data and an objective measure if the road was closed. So we found a trigger solution there. There's an interesting one regarding volcanoes that we worked on. Key supplier not rebuilding. So you rely heavily on this key supplier. If they have a physical damage and they choose not to rebuild, now your operation is permanently impaired. We've looked at some things like that, and then labor costs. Interesting, using a Bureau of Labor Statistics data. So lots of information on the slide. We appreciate. And with that, I'm going to turn it back over to Chris, and I'm sure you'll probably have some questions where we can dive in deeper on this or any other questions you might have.
Yeah, thank you, Scott, for a fantastic presentation here. Before we go into questions, and we have quite a few here, I wanted to quickly poll the audience for their interest in topics for future webinars. So you should see a poll on your screen. Feel free to select multiple options, and this really helps us inform kind of where your interests lie and potential content for us going forward. So thank you for that. And now we could get into Q&A here. There were a number of questions, Scott. I kind of wanted to stick with the theme around, you had mentioned in kind of an example road blockage. And there's a question about, can you use NDBI for nationwide transportation companies if roads are blocked due to weather, protests, rock slides, etc.?
Yep. So, and I appreciate sort of, these are not pre-planned questions, so I will do my best to answer on the fly here, and then of course we can follow up with a more detailed conversation. So the key word I heard in there is nationwide, and so the key to these solutions, you know, theoretically you can insure anything, and theoretically you can put as many trigger locations on the map as you want. Realistically, budgets matter to pretty much every organization. So in my experience, finding that sweet spot, it tends to be more of a what we'll call a tail scenario, that folks will want to sort of pay the risk transfer fees to transfer the risk. And so when you have a large network, any kind of national type footprint client, the key will be finding the right triggers, right? If it's a type of thing and it's such a large footprint that it happens every year, well, that doesn't quite make sense for a risk transfer solution. If it's a type of situation where there's that really horrible perfect storm situation where there are many events in a particular year. In any given year, there's only one or two, no problem. But if there's the year where there's many events, yeah, the key is to sort of tease out the data, find all the objective triggers, the things we talked about already, but then tease out that sort of sweet spot where it's a remote enough thing where the cost of that risk transfer is sort of makes sense for most people's budgets and thoughts on insurance products.
Thanks, Scott. I'm going to just quickly go back to the poll slide because that advanced quicker than I wanted. And then I will, Scott, I'll bring you to our next question while we leave that up. How do you determine an appropriate limit for a given coverage?
That's a great question. Thank you whoever asked that. Yes, it can vary, right? Of course, I'm going to give a very insurance company answer. It's like lots of answers. Generally speaking, to give everyone a rule of thumb, when it comes to these really unique type risks and type solutions, A sweet spot for us, I mean, is, we have to have enough premium to sort of make it worth doing this investment. Again, the sort of custom tailored clothing outfits sort of comparison. But for us, somewhere 5 million to 10, sometimes 20 million of limit. A lot of the solutions could just fall in that sweet spot. If it's something that's really unique to us and different for us, but we feel like we can get our heads around it. A 10 is a 10 million limit tends to be a good number. If to get sort of into upper, like limits you might see us put forward for more natural catastrophe type situations, maybe 40 or 50 million dollars, or maybe even north of that. It tends to have to be something that we really, really are comfortable. Like for instance, natural catastrophe, Swiss Re, very, very comfortable with. So the range it varies depending on sort of how well we feel like we got our arms around the risk. But again, a lot of these products tend to be very supplemental in nature. So, those 5s and 10s and $20 million limits, again, if it's a mega global company, maybe that's not very meaningful. But for a lot of the folks that have some of these unique risks, or even just sort of dipping their toe into starting to transfer some of the risks, those limits can very, very helpful. So I hope that answered the question well.
Yeah, thanks, Scott. We have a number of questions, so I'm going to kind of bundle them together around triggers and data sources. So does a data source / trigger need to be publicly available, or can it be private data as well?
Great question. Oh man, these are great. I love the question answer portion of it. That's really good. So yeah, the answer is can be either. So in short, we have used. The government is our favorite partner when it comes to data, and I say partner, although we're not controlling them; it's independent. But as taxpayers, we pay for a lot of really, really interesting data from, particularly in the U.S. Again, sorry for the U.S. focus, but lots of countries have a lot of good data as well from some of their public entities and their either their federal or their state or provincial governments. But yes, using the public data can be very good. It's great from our standpoint as the insurer because there's often a huge history. As the buyers, from the buyer standpoint, there's a lot of comfort in the reporting from the governments, and so it makes for a nice solution. However, there are solutions that we use that are very proprietary data that are often behind a paid wall. The revenue per available room, the RevPAR data, is a perfect example. That is a hotel industry or tourism industry product that there's one key provider that we use. They pull. Most of the hotels belong to the organization, and they pull those entities and collect the data. So something, again, even if it's behind a paid wall, in that case, it's a paid wall that's very familiar usually to the insured, and so we're usually, there's a mutual comfort there to use it. But yes, absolutely, we can use very, sort of unique data. Some of the natural catastrophes sort of products that we do, one of our products uses localized wind speeds that's produced by RMS. So again, and it's not free. And so one of those a good example of a product that we use from a third party, but again, RMS being sort of one of the top 2 or 3 modeling companies and data companies when it comes to insuring natural catastrophes, really well known, really well respected.
A question about limit and capacity deployment. What is the maximum limit you could put out for an NDBI product?
Yeah, I'm going to have to give a vague answer on this, and I'm really sorry, Chris, and the person who answered. It really depends, and so I'll just dovetail my earlier answer. I mean, if you're talking about natural catastrophe, it's almost the sky's the limit. I mean, between Swiss Re Corporate Solutions, we have a parent that happens to be a global reinsurance company, and then we also have access to the capital market. So I have worked on very, very big deals that are maybe natural catastrophe triggers that were purchased for either classic first-party parametric style reasons, or other times actually very, very non-damage business interruption reasons, very, very strong impact to the organization. I'd say most really do fall sort of in that 10 to 20 million limit, especially if we're getting super, super esoteric.
Thanks, Scott. There have been a bunch of questions about airports and a few about seaports. So what are your thoughts as to the long-term capacity implications of insureds using airport or seaport locations or traffic as triggers?
Yes, yep. This I truly believe, and this is now Scott speaking and not necessarily Swiss Re speaking, but I think we will find a day in the not too distant future where the capacity for any kind of triggers regarding a seaport or an airport is so scarce, because if you think about an airport or a seaport, the number of organizations that need those things functioning in order to survive is amazing. When you think about the risk of an airport, it is not just the municipality that owns the airport. It is not just the airlines that use the airport. It is the business community that needs the airport. It is the tourism community that needs the airport. It is shipping of goods that need the airport. It's just an immense number of organizations that utilize these public resources. And what do you do as an individual organization if that resource goes down for a period of time? It's incredibly impactful to the finances of the organization. And so I think as people start to look at risk and risk transfer a little bit differently, and now that we have these data quantifiable tools at our disposal that we can use, and we're getting into this hyper data world where so many things are being measured, I think we can really use these to solve new problems. But the number of people that need them, the number of organizations that need them, are so grand with some of these like really key infrastructure assets that as people start buying these, there may be a situation where the insurance industry just has so much limit exposed to these individual locations on the earth that it may become a problem. So yes, for those reading between the lines, I'm saying act first so you can get yourself some of that capacity.
Scott, we had a lot of questions that we didn't have time to get to. And to the audience, we commit to replying back to you directly with answers to your questions in the next week or two. So thank you, everybody. This has been fantastic. And I just want to quickly put up our contact details. If you have any questions that you didn't have a chance to ask during the webinar, please feel free to reach out to Scott or me or anyone else, any other contacts you may have at Corporate Solutions. We'll have the recording available of this webinar in a couple of days, and we'll send that out for you to, should you be interested in listening again or sharing that with colleagues. And if you have a second, we'd love to get your input about this event itself. And you can see the poll up on your screen now. And finally, really hope you can attend some of our future upcoming webinars. Next up, climate change, secondary perils, and the cost of unpredictability on June 24th. And in July, we're going to hold two webinars. One on our parametric product, Hail, which is very new to the marketplace, and one on strategies and impact of the hardening market. We'll also look to add more events based on your feedback today, so stay tuned for details and invitations in that area as well, and keep a watch out on the Swiss Re Corporate Solutions LinkedIn account for updates there. Thank you so much again for joining and spending this hour with us. Be well. We look forward to speaking with you soon, and enjoy the rest of your day.